Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. Last week was a little slow, but do not worry because this week things are definitely ramping up. Big data drops are happening this week. The 30-year fix is currently sitting at a 6.74, which is down 1 basis point from last week's 6.75. So without further ado, let's get into the data and look at the charts. U.S. 10-year yield. Now, the yield has been doing the same thing it's been doing. It goes up, goes down, up, down. It's really stuck in this range. So nothing crazy is going on with the interest rates. I like I said last week, I wouldn't expect any huge pop-ups or drop-downs. However, there is an event going on this week that we will talk about shortly, and that could change. The 10-year yield could make a decent sized move in either direction, so we're definitely going to keep our eyes open for that. But yeah, so like I said, the 30-year fix dropped about 1 basis point, and these movements are just super small at this point. Nothing crazy. I mean, the movements that we're having from here to here in the span of a few days, we had more movement back here, right? Like these were big jumps in the upwards direction, raising the 30-year fixed, while over the course of a few days, we're not even really getting that. Let's see, this candle looks to be larger than this whole movement across the span of a few days. So we're definitely going to keep our eyes open. The bond market is pretty indecisive right now. It's going up, going down. It's really it's a kiddie roller coaster, right? We aren't seeing any huge peaks in the upward direction, any huge drops. So until we see that, we would not expect any radical moves in the 30-year fixed. Now, last week, like I said, it was a pretty slow week. We had Powell speaking, but I don't think that really moved the market too much. We had flash manufacturing PMI, and like I said, this is just a survey to see how manufacturing's doing. This is a survey from purchasing managers. Manufacturing is not doing as hot as it was or as was expected to be. I believe anything below 50 is a contraction. Anything above 50 is an expansion. And when we look at the services, that tells a different story. Services are doing well. New home sales, not terrible at all. It was better than the previous months. However, it was not as was expected. So it looks like home sales, they are still ramping up to a degree, but not as much as the forecast was. Now this week, like I said, this week is a big week with a lot of data coming at us. So first we have JOLTS. This is the job openings. This is all employment information. The labor market has been doing pretty solid, so no concerns. We're gonna look and see what happens with JOLTS, but really, I don't think there's any expectations that anything's going to be crazy off. If anything, the expectation is that it'll be slightly better. So, well, the forecast is that it'll be worse, but I wouldn't be surprised if it was either at previous better or somewhere around the forecast. It would be more surprising if things turned sour because that's just not the way things have been going. We're going to look at ADP non-farm employment change. And let's see. So it's expected to grow. This is, of course, the estimated change in the number of employed people during the previous months. And there's an expectation that there are going to be more jobs. So we will keep an eye on that. And that is Wednesday. Wednesday is a pretty big day. We have that. We have pending home sales, which that's important for us, not so much for the market. But then the big thing is that we have the federal funds rate. Let's see. We can probably pull up. Let's see. FOMC. Let's see. Predictions. I think that's, we want to go to the Fed watch list. Let me see if I can find it just real quick. Probabilities, yeah. Okay, so the probabilities, it's a 97% that it is going to be a pause. But September, it's a 60% chance of a cut, 50% chance if we don't get that in September, that we get it in October, and then a 42%, it's 60% in September, 50% that we stay at that cut, and then a 42% chance in December. So really the market is pricing in 2 rate cuts, while it's more than likely going to be a pause for the federal funds rate. It's probably going to stay at 4.5%, 4.25 to 4.5. It's really important, this FOMC press conference. We want to see what the Fed has to say about the state of the economy, about the state of the labor market and inflation. And then we want to see what Jerome Powell has to say. There's been a ton of pressure on Jerome Powell from the president to cut rates, but Powell is standing his ground and saying, the Fed will do what the Fed does based off of data and not based off of politicians. So we will see. We will see what he has to say. Usually he doesn't have much comment on what Donald Trump has to say, other than, the Fed is data driven. So we'll see what that says. We also get on Thursday unemployment claims. It's interesting to see personal income, personal spending, average hourly earnings, and then non-farm employment change. So we have the ADP. Let's see. Okay. An early look at employment growth 2 days ahead of the government released employment data. Okay. So this is just kind of a forecast. And then we're going to see the actual numbers down here. And then we have the unemployment rate. And then we also have manufacturing PMI. So this is going to be important to see. And then we have the revised University of Michigan inflation expectations and the consumer sentiment. Those really aren't going to be that big of a deal. So really, the main attraction is going to be Wednesday, and then following Thursday and Friday. Definitely big data drop days. And we really have to keep our eyes open. Like I said, really anytime Jerome Powell speaks, we want to keep our eyes on the market. We want to keep our eyes on the market because we want to see what the bond market is doing. If the bond market moves any way drastically up or down, that's going to impact the 10-year yield. The 10-year yield, of course, is what the 30-year fix is based on, and we want to see interest rates come down, of course. So we want to see the bond market go up because the bond market is inversely correlated with the 10-year yield. So let's just keep our eyes open and follow what the data says. Again, 6.74 as of July 24th, down 1 basis point from the previous 6.75. That's all I have for you this week. If anyone has any questions, definitely reach out to us at 877-TEAM-MBL. Any mortgage questions, any refinancing questions, any purchasing questions, anything like that. If you just have any questions about these videos or anything, definitely reach out to us. Visit us at www.mortgagesbylinda.com, and I will be reporting back next week to take a look at the data with you all. Have a great week. Bye.